Welcome back to Slacker Trade Sunday Brief for the week of August 10th. Last week was full of big market moving events. On Monday, news about halting a planned attack on Iran caused oil prices to drop and stocks to rise. Then on Tuesday, Palantir reported an impressive 93% revenue growth, sending its shares up nearly 30% in a single day. The most surprising came on Friday, when July payrolls showed a decline of 23,000 jobs instead of the expected increase of 85,000. Despite this negative jobs number, stocks rallied higher. That's because a weaker labor market reduces the chance of a September rate hike. So the market is currently embracing this jobs shock at record highs. This coming Wednesday, we have the CPI report, which will be a key test for this market sentiment. Let's dive deeper into these developments. Starting with the index board, for the first time in a while, all three major indexes are trending up in our models. The S&P 500 closed at 773, up 3.5% this past week, and reached a record high. The NASDAQ 100, or the Qs, closed at 723, gaining 5% for the week. However, it's still facing resistance near 728.5, which interestingly falls within this week's expected move range. Meanwhile, the Russell 2000 also rose about 3.5%, closing just above 301. Expected weekly moves are roughly $8 for SPY, $12.5 for QQQ, and $4 for IWM. So, with record highs and calm pricing, all eyes are on Wednesday's CPI report to see if these uptrends hold steady. Now, here's an insight you won't hear anywhere else, because we calculated it ourselves using 31 years of index history. Last week, the market gained more than 3% and closed within 2% of its 52-week high. This exact scenario has occurred 52 times since 1995. What happened the following week? Well, the market closed higher 62% of the time after such weeks, showing a tendency toward gains. Interestingly, it only exceeded its expected move 8% of the time, compared to 19% across all weeks since 1995. This tells us that weeks like last week are usually followed by quieter, less volatile weeks, not wild swings. Additionally, the downside remained within one expected move 94% of the time, which is especially important for premium sellers. So historically, the market leans toward calm after strong closes near record highs. The one variable that could change this pattern is what happens on Wednesday. This week, the spotlight is on one key economic data point, the July Consumer Price Index, or CPI, coming out Wednesday at 8:30 a.m. Economists are forecasting a 0.2% increase for both headline and core CPI. Now, this number is crucial because it will heavily influence the odds of a September interest rate hike, which currently stand near 43% according to the CME FedWatch tool. If the CPI comes in hotter than expected, those odds will rise. But even if the number matches expectations, that won't necessarily rule out a rate hike. Bank of America points out that an inline print still strengthens the case for tightening. On the other hand, a cooler CPI could reinforce the narrative for a weaker jobs report and possibly delay hikes. Surrounding Wednesday's CPI, Thursday will bring the July Producer Price Index and initial jobless claims at 8:30 a.m., followed by key retail sales figures and preliminary August consumer sentiment on Friday. The week also includes the weekly options expiration on Friday afternoon, with the monthly expiration scheduled for August 21st. On the earnings front, Tuesday after the market closed, we get reports from Supermicro and CoreWeave, which are important reads on AI infrastructure, an area investors are closely watching. Later in the week, Thursday features JD Compom, providing a consumer perspective from China, and Applied Materials, with expected earnings per share of $3.39, up nearly 37%. This makes Applied Materials one of the cleanest tests of AI-driven capital spending on the calendar. Overall, it promises to be a data-rich week, with significant implications for monetary policy and market direction. This week's sector review is really a triage of what's continuing, what needs confirmation, and what's fading. Starting with what continues, materials are leading the way, showing the best performance over the last month, with a gain of over 5%. Last week alone, they rose nearly 5 more points, driven by solid demand rather than just headlines. Freeport, the largest copper miner, has been a key player and is up about 41% this year. Moving to what needs proof, technology saw the biggest weekly gain at over 7%, mainly fueled by a strong quarter from Palantir. However, the sector is up only about 1.5% for the month, so we need earnings from companies like Supermicro, CoreWeave, and Applied Materials to see if this bounce is sustainable. On the fading side, energy had the worst week, dropping over 3%, but that decline is tied to a single de-escalation headline, which means it could just as quickly reverse course. Lastly, consumer discretionary, which we highlighted as a leader last week, ended up third out of 11 sectors, and the upcoming retail sales report on Friday will be a crucial indicator for its momentum moving forward. Here is the map for the week. Applied Materials reports earnings Thursday after the close, and this is the cleanest single test of AI capital spending on the calendar. Then on Tuesday, Supermicro announces earnings, giving us a fast read on how much appetite remains in the AI infrastructure trade. Moving to Freeport, they're the copper leader in the market's best performing sector this month, which is up about 41% this year, making them a key rotation leader. The QQQ, representing the tech sector, is having a strong week going into Wednesday's CPI report, with resistance right up at 728.54. This is where the market's verdict for the week really prints. Lastly, utilities remain the only sector negative on the month. If the odds of rate hikes keep falling, this is where the rotation back to defensive plays could begin. These points give us a clear roadmap for what to watch closely this week. The bottom line here is that despite last week's job shock, the market not only held steady but actually rallied to close at record highs. Looking back over the last 52 weeks with similar patterns since 1995, only about 8% of the following weeks have exceeded their expected moves. History suggests calm. Now, the key data point coming up is Wednesday's CPI report, expected to rise by 0.2. This report could shake things up, but even a number right on target keeps the possibility of a September rate hike alive. Our focus isn't on predicting the exact number, but rather understanding what trends continue, what requires more evidence, and what is fading away. We position ourselves for the week based on probabilities, not the headlines that often stoke fear. If you want to see how we trade through weeks like this, join us at slakurtrades.com. Subscribers get a weekly watch list featuring high implied volatility names, along with trade callouts when setups align. We don't trade every ticker every week, and we're upfront about that. So trade the premium, not the prediction, and trade the week with us. Hit the like button and subscribe to our YouTube channel.